Welcome to Industry Insights. Thank you all for joining us today for the 2022 real estate market discussion, Fortune or Fallout. It is my pleasure to introduce today's special guest, Scott Trench. I am particularly excited about today's episode, genuinely, because I'm a huge fan of BiggerPockets and what they're doing for the real estate investor community.
Well, thank you again
Yeah.
for all that. And
Um,
I'm obviously very excited
Scott, I'm
to
not
talk
done.
about the. Oh,
Did you
go
did
ahead.
you think I was done? I mean,
Sorry.
come on, you're a little bit of a bigger deal than that.
Uh,
So, like I was saying, I'm a huge fan of BiggerPockets because of what you're doing for the real estate investor community. Um, at Civic, we get to help with investors with financing their real estate investments, but BiggerPockets is there as a resource for all of you in this room along the way. And we're thrilled to have Scott with us today. Scott Trench is the CEO and president of BiggerPockets.com. Scott graduated from Vanderbilt University with degrees in economics and history, corporate strategy, and finance. And he has dedicated his career to helping ordinary Americans build wealth in part through real estate investing. Since joining BiggerPockets in 2014, Scott authored the book, the wealth building book, Set for Life. And he also joins Mindy Jensen as a host of the BiggerPockets Money podcast. He stays super active in the BiggerPockets forums. He contributes to hundreds of articles, market analysis, on and on and on. He's been featured on CNBC, NBC, other traditional news outlets, and he is an active real estate investor himself in the Denver market. Currently, he manages a private portfolio of about 1.5 million in his real estate assets under management, and he also holds his real estate license as a Colorado broker. So, with that said, I'm pretty sure you're qualified to have this discussion today, Scott. So we are thrilled to have you.
I'm like I said, I'm thrilled to be here. I love talking about real estate in the market, and all of those different related topics. As you mentioned, I'm really passionate about private wealth building, and real estate is a great tool for a portion of the country, not everybody, of course, with that. But if you're making $50,000 to $200,000 a year and you're looking to build private wealth on the side, real estate is a really good option as part of a overall portfolio with that. So really focus on that space for the person who's trying to buy a handful of properties, perhaps over a 5-10 year period, and use that as a part of their overall investment approach. So that's been my particular favorite niche. Of course, BiggerPockets helps everybody, depending on if you want to do one deal one time with your personal residence, or if you want to build a portfolio of hundreds of units across single families or multifamily. And we're starting to branch out a little bit more into the commercial space as well, although that's new territory for us.
One of the things that we're going to dive into today with Scott is talking about where the market has been. So before we jump into 2022, what can you say your take is from all of the analyses that you see about where we have been?
Yeah, well, maybe I can kind of zoom out and think about, investing in general, and then define the market as kind of I look at it, which is this market of single family rental properties, duplexes, triplexes, and quadplexes. There's a big part of the market that I'm not quite as focused on, including large apartment complexes, like commercial real estate, like retail, self-storage, those types of areas. So when I talk about the real estate market, I usually refer to that market not of primary residences either, but of single family rental properties, duplexes, triplexes, and quadplexes. So that's how I'll frame the discussion. And then when I think about the overall context of investing, that's a little bit broader and can zoom out there. It's the end of 2021. We're heading into 2022. Where do you go for yield right now from an asset class perspective? Do you go to the stock market, which is trading at all-time price to earning multiples? Do you go into bonds and purchase debt with interest rates at all-time lows and likely to begin perhaps a period of rising over the next couple of years? Do you go into cash with inflation looming? Do you go into Bitcoin? Do you go into private business asset classes, or do you go into real estate? And so I think that in the context of that market, and real estate, of course, has had a big price run up over the last 10 years, and particularly extreme in the last year. But in the context of that investing landscape, where do you go for yield? I mean, cash could be just as destructive to your wealth generation as one of the asset classes I just mentioned there, if you believe that inflation is looming and likely to be sustained over a period of years. So I think in that context, you say, where's the good place to invest? Well, maybe you have to reframe the question and say, where's the least bad place to invest in that? And either way, I look at it. I obviously I'm perhaps a biased source with from BiggerPockets with this, but I think real estate is a reasonably attractive asset class in that context. So that I think is the first way that people in worldwide, or at least nationwide, are probably framing the decision to invest. Zooming down into the real estate specific market, we have a couple of interesting trend lines to note. One is, if you take the all American housing stock, there are perhaps 125 million units of housing stock, 125 million residences. I'm about 2 or 3 years old on that data point, so that could have changed by a couple 100,000 or a few million with that. But you have 85 million or 80 million of those units, about 80 million of those units are going to be single family owner occupied properties or secondary homes. And then the remaining 45 million rented residences are going to be broken out. 18 million of those 45 million rented residences are going to be single family properties. And another 8 million of those units are going to be duplexes, triplexes, and quadplexes. So again, that's the market that I focus on. And that market is special because 90% of those properties are owned by investors who have 10 or fewer properties. The only 8% are owned by investors that are classified as non-institutional investors that own 10 or more properties. And only 2% of those properties are owned by true institutional players with that. So there's all this talk about institutional investors moving into the single family market, and they are present in some markets nationwide, but they're really a non-factor when you look at the national housing inventory. And I think it will take many, many years for them to become a player. Why is that distribution the way it is? Well, I think that financing is a huge part of that. In this country, you can get a 30-year fixed rate Fannie Mae conventional mortgage on a single family rental residence, and you can get up to 10 of them as a regular investor like myself. So I think that's a huge part of the play there. There's perhaps other advantages that these investors have, like being able to self-manage, or at least having that option at the beginning before hiring a property manager, and maybe some non-spreadsheet, non-truly quantitative items that come with analyzing a local market by living there and operating in it. But I think that financing piece is probably the biggest thing that is keeping that market dominated by small mom and pop investors. Exacerbating that point, nearly 50% of single family rented homes are owned by investors with just 1 or 2 properties. So that's an overview of the market of properties, how it currently exists. And there's a whole bunch of other things like inventory that we can get into with this. But the other thing to think about is who are these people that own these small properties? Who is this mom and pop investor with 1, 2, 5, or 10 properties accumulated over decades? Well, there are 15 million of these people in the country, 15 million people that we estimate that currently own rental properties outside of their primary residence. And of those 15 million people, 11 million of them are over the age of 55. At BiggerPockets, we politely refer to that group of investors as not digitally native. So these investors are ones that are not going to learn about real estate investing on a platform like BiggerPockets or on the internet with that. And that factor, I think, is one of these. It seems like interest in real estate is growing over the years, or has particularly picked up in the last couple of years. I'm not convinced that is necessarily the case. I think it's perhaps part of the equation, but I think a bigger part of the equation over the last 5-10 years is the simple fact that this is one of those areas of investing that requires a significant amount of capital, good income, good credit. and that the portion of the market that is capable of buying real estate is simply aging into that on a year after year basis. And that's a big tailwind from this market. So I think that that's something to consider, while also perhaps acknowledging that, yes, perhaps real estate is gaining interest nationwide, but it's hard to quantify that. It's much easier to quantify the market share of digitally native investors that are entering this space. So these people are typically earning $50,000 to $200,000 a year. Yes, there are people that are wealthier that invest in real estate, but we found, interestingly, that the price to getting started in real estate investing is more than just a financial one. Folks typically need to put in dozens or hundreds of hours to learn about real estate investing before they feel comfortable making a commitment that is perhaps the largest investment of their life, maybe outside of their college education or their first home purchase. So that price is much cheaper for somebody making $50,000 a year than for somebody making $400,000 a year, like a doctor. So we do see investors in real estate that earn that those higher income tiers, but fully 85% of our audience, for example, are people earning between $50,000 and $200,000 a year. And then, of course, if you're earning less than $50,000 a year, it's hard to just get to the starting line of saving up that down payment or qualifying for a mortgage to buy property.
And next up, taking the guest, the mic with our guest today is our very own Bill Tessar. Bill is our president and CEO of Civic. He has over 30 years of mortgage industry experience, and he previously founded and served as president of 3 different mortgage companies, taking them to a residential funding volume of over $35 billion. Since joining Civic in 2017, Bill's taken Civic to surpass some major milestones, including the most recent funding over 13,000 loans. We are almost at our $6 billion lifetime volume milestone, which is very exciting. Bill is a Glassdoor top CEO, and I am proud to add to this list of his accolades that he has also been recognized as a top CEO for diversification and top CEO for women, which I can attest to. He is a Housing Wire Vanguard Award recipient and just a true voice in the lending industry. So without any further ado, I am happy to kick things off by welcoming our president and CEO, Bill Tessar.
So listen, the interesting part about this time of year for me anyways, is you get to look backwards and say, what was the 12 months like? And it was a little bit of chaos. You reflect on where we are today, but more importantly, this is where the planning starts for 2022 and has always been really the most exciting part of the business calendar year for me. And as you put your ear to the grindstone, you hear kind of like there's some people that are concerned. They see an inflated stock market and somehow they associate that with real estate. And there's an awful lot of talk of interest rates, and we'll get into supply and demand. But with all the craziness, real estate overall has still been pretty positive and pretty bullish. And you and I talked the other day, and I think, it really started with some inventory levels. So I don't know if you'd mind jumping into your thoughts about the supply and demand as it relates to that. You shared some things with me earlier in the week, and some of the numbers you shared in terms of years it's going to take kind of set me down a bit. I hadn't heard those before. So maybe we can start with that if you don't mind.
Yeah, well, can I just finish out for another 60 seconds the description of these investors, and then I'll go right into inventory if that works.
Yeah.
So we just described this investor with a couple of other trends. So we have the shift from older investors to digitally native investors occurring year after year as a long-term driving force in this market that I think is one to acknowledge and understand. We also have I think 1 or 2 other trends that are important. There's a rise of high income renters in this country. And I should know the reasons behind that a little better. You can speculate that millennials are just moving around or not settling down in various cities, but we have more and more net new household formation is renter households, and we have a lot more high income renters. And then lastly, we have the short-term rental market, which we know there's millions of homes short. Airbnb CEO mentioned that in May, and I think that continues to be the case today. And I think that is going to continue to be an interesting trend line to watch for this market, as well as the dream is to have passive income as an investor. But if the yield is 50% cash on cash returns or something in that ballpark from a short-term rental perspective, that's going to be interesting for investors as well. Although there's a lot of legal gotchas that we can get into around that market.
Well, on the short-term rentals, we just came back from IMN. I think there was 2,000 participants, and it was dominated by the short-term rental space and build-to-rent space. The short-term rental space is really kind of taken over that whole market. And guys like Advanced, Sean Bruner, and those sorts, they're raising a tremendous amount of capital, not just as a boutique to open up for people like you and I who have properties that we want to share with others, but they're actually acquiring them themselves in large blocks and then beautifying them and putting them as part of their inventory. It's a crazy time. So it's just not an appreciation play, to your point. The cash flow is unbelievable.
Yeah, I think that's a really interesting one. That's really exciting. Lots of cash flow potential and the chance to own premium assets in a way that you may not be able to with the long-term rental market.
You touched upon it. I want to stay here, and then we can go back to inventory in a second, about the regulations and how certain cities prohibit the short-term rentals, and really knowing what those cities are and how you get in and out. I think what Advanced has done very well is they've gotten connected to local legislation and get a good understanding, and actually even partnered up with some of the cities so that they have a vehicle that they could exercise their game plan in, because without that, that model has some challenges in it. Your thoughts on that?
Like Denver is a great example of this, right? In Denver, it's not legal to buy a property that's not your primary residence and rent it out as an Airbnb or short-term rental with that. But in neighboring Lakewood, which is steps away from certain Denver hotspots, Airbnb is perfectly fine. So that's where I think this local knowledge of these markets is really important. And then not just that local knowledge, but understanding dynamics and trend lines and mitigating risk. Because if I buy a property in Lakewood as an Airbnb and Lakewood later changes its rules, which can happen, and that is a trend line in some cities, in some areas, that can affect my whole game plan and create tremendous risk if, for example, I don't have a backup plan to keep that as a long-term rental. So there's a lot of unknowns in that space, but it is clear that if you can find those areas that can sustain that people are generating tremendous cash flow, and there's perhaps a window of a few years here where that might be a really good opportunity to exploit. Yeah,
and I think what people don't understand, right? Rates are, we called them at zero for the last 3 years. They're so low. On the conventional side, you can get 5, 7, 10-year IOs with documentation in the high 2s, low 3s. And then on the business purpose loans, call it in the 4s. But, to put that in perspective, on $1 million loan, 3% is $30,000 a year interest plus your taxes and insurance and maintenance. That could get covered in a month of Airbnb. So, the numbers are unbelievable when the financing is set up properly. And I think, we're seeing that there's new products coming out, and we could talk about that in a bit. But the Airbnb play, the home away, the VRBO, it's unlike anything I've seen in a long time.
It was only right that it was Scott's turn to have it.
I was waiting. Yes.
It's only fair, right? So one thing that Scott was touching on earlier, Bill, is talking about where things have been as far as the evolution to where they're about to go in 2022. So what's your take on kind of the journey that the market has been on over the past couple of years?
Yeah, we'll jump into this when he gets back, but so inventory levels from a supply and demand perspective are said to be somewhere north of 5 million homes. One of the things Scott shared with me early in the week is they believe, based on current build rates, that the duration of time it's taken builders to come in and build inventory, we're 9 to 10 years away from filling that gap. So if you just think about this, if everyone takes a step back, not emotionally, just objectively, and you take a look at our inventory levels, which are, let's call it 5 million homes underwater, you look at interest rates, and even if rates are rising, and they are, but even if they're rising, they're still ridiculously low in perspective of where they've been over the last 30 years. And then obviously inflation and income levels. I would say that I'm as bullish about real estate today as I've ever been. I just think that when you look at all the factors, you just don't have a lot pulling away from it. And so I'm talking about personal residence. I'm talking about second homes. I'm talking about short-term rentals. I'm talking about multifamily or your investor pool. And we see the whole gamut on our investors, from the onesie twosies to, I think our biggest investor has 800 single family residents that they've accumulated at a pace of like 20 to 25 a month, because they too believe in this long-term rental play. So I think when Scott gets back on, he'll echo those sentiments. But the marketplace today, everyone's always afraid of the appreciation we've seen. Like, maybe it's too late, I'm going to wait for the pullback. And then you look over your shoulder and you've lost another 18%. And you look over your shoulder and you've lost another 10%. I think obviously setting up your financing properly is important, but getting into the game now is probably never been more right. And I think, when you think about real estate, like in general, all of the economic factors that support a bullish market are in place. And it's interesting, in the many interviews I've done and people I've talked to, they always kind of revert back to the stock market. And, arguably the stock market is at a fever pitch high. So like, it's never been higher than we're seeing it today. And some of these levels, and with the SPACs and so on, are trading at numbers that don't make a whole lot of sense. Yeah, there could be a regression there. I think that's the norm, but I don't think that necessarily has anything to do with real estate. I think there's been some that have kind of carried on, that the market pulls back, so that's going to impact real estate and they're going to go in lockstep. And I don't necessarily believe that's true. Yeah. So one of the areas we talked about, I'll just keep this going, is geographically what's going on. And I think what we saw in early 2021 is we had what we called the bookends, which was California and New York, and they were all going inbound. And when I say inbound, it was probably the biggest migration in almost 38 years that I've been running finance companies that I've ever seen, even within our own firm, where people were coming to me and saying, "Hey, listen, Bill, California's got 14% state taxes. The cost of living has never been higher. I've now proven I can work from home. I want to give a better life for my family. I want to be closer to my parents. I want to have, all the seasons." And they've been moving inbound. Our people have moved to both Carolina, South and North, to Nashville, Tennessee, to Vegas, Arizona, and Florida, to Idaho, and that in Texas, Houston, Austin, Dallas, and that continues. And I think, one of the benefits, if you turn on the stations or radios, you hear all the crappy things about COVID, and it's been horrible. It's taken lives and it's hurt people economically, and it's really upended our world for, call it, almost 2 years. What it's done remarkably well is it's proven to the world that you don't have to have 300 people, 500 people, 50 people under one roof, shoulder to shoulder, to meet corporate objectives. And the hidden message under that, from a real estate perspective, is you have people that are really stepping up their housing in terms of their personal residence, because they're building their offices in there. They're educating their kids in their homes. They're taking care of their elderly parents in their homes, not wanting to put them in homes. And so, home sweet home has got an entirely different meaning. Also adding to the supply and demand pressure, because people just aren't getting in and out of their properties as quickly as they were in the past. Most importantly, geographically, you see a lot of people going inbound. They're saving on state taxes. Their dollar stretches further. They're getting more bang for their buck, bigger houses. They're getting property. And I don't see that stopping in 2022. That doesn't mean that New York and California haven't realize their appreciation. Here in the South Bay, Manhattan Beach, Redondo, Hermosa, appreciation's been off the charts. So, some of the people on the outside are coming in. But what I am telling you is, if you're thinking about real estate and how to stretch that dollar and how to get like real appreciation and or cash flows, we're seeing those neighboring states as being, super strong. And then obviously Pennsylvania, you could get yourself a 3-bedroom, 2-bath for $120,000 out there. And so that also begs to argue, hey, look at us over here. I don't really see any non-hot spots other than where people are coming out of, but I do see Vegas, Arizona, Florida, different parts of Texas, South and North Carolina, and Tennessee as really driving the market through 2022. Like when you talk about supply and demand and you go take a look at those states, it's unbelievable. My oldest son, I think tried for 5 months, and the average number of offers in the properties he was trying to buy in the state of Arizona was somewhere between 20 and 25. And it was only, through like all cash offer, waive contingencies, close in 7 days, was he ever able to consider or have them consider an offer to get into a piece of property. So, we don't see that craziness quite so much today. I think there's been kind of an exhale. There's probably been a little bit of seasonality with the holidays and whatnot, but I actually see that picking up quite a bit. And so, the question about geographically, the way I think about it is bookends in, and then those neighboring states are really getting the benefit of those dollars and those families and those people. And I don't think this is short term. I think this is going to be the new norm. It'll be really interesting to see how some of these bookend states react once this story is done being written. I don't know if Scott's on, but if he's not, I want to just continue to go because we had a lot to cover. And interest rates seem to be one of the hottest topics that is impacting the way people think about real estate. So I spent 30 years on the conventional side. So I have a pretty good handle about what happens there. And then, the last 5 over on this side. And so here's my thoughts. I've been calling an interest rate increase for the last 3 years, and that hasn't happened. So I'll own that. I was pretty sure about it in 18, 19, quite sure about it before the pandemic hit. I am 100% certain that rates can only go one way. And for all of you that don't know this, you really follow the 10-year. The 10-year treasury is a really good indicator of what's going to happen with long-term mortgage rates on the conventional side. And so I think it sits somewhere around a 1.45. Remember, y'all, it was below 70 basis points. So it's already doubled. And what I'm hearing is that number could reach a 200 basis point number before the end of 2022. My personal opinion is when it really starts moving, it's gone. It's not going to be 145 to 155 to 162. You're going to wake up and it's going to gap, and it'll be 145 to 170. And then all the smart people on this call will say, oh, it's going to come back a little bit. I'm going to wait to lock. And then it'll be 185. And then it'll be the 200 will be the new norm. And those interest rates that we enjoyed for the last 3.5 years will be gone. Did you want to say something, Gina, before I continue on here?
Scott has joined us via phone. So
Okay.
I just wanted to give a double check. Scott, are you there? All right, let me try to unmute one more time. We're going old school to the telephone audio.
Hello, can you hear me?
There he is.
Hey, Scott,
Guys,
this is all time, you and I, all time right now.
Yeah.
I don't
We
think
lost
anyone's
power
following
here.
us because we can't even use our phone. And you just joined the 55 and over club, Scott.
I know. Yes. I apologize, guys. This power's gone out here maybe 3 times in my experience over the last 6 years. So what a bizarre thing here. And I'm calling you via cell phone now. So sorry about that. And again, really appreciate the opportunity, and embarrassed to have lost power here for you.
No, I wish I had an excuse. We just couldn't figure out how to unmute me. So I don't have the benefit of saying we had a snowstorm. We're talking a little bit about interest rates, Scott. Why don't you share your perspective? I started to share mine, and I'm sure they'd be more interested in hearing yours.
Yeah, well, I think on interest rates, your perspective is going to be much stronger than mine in this particular area. My kind of novice understanding on interest rates is simply kind of taking what the Fed and the government have kind of indicated to us for next year, which is a rise of about 25 basis points, coming in Q3 or Q4. But I think the longer term trend, I think the bits that I heard you talking about while I was also frantically trying to get unmuted here sounded very, very, very intelligent, made a lot of sense to me from a longer term perspective. So, going into next year specifically, it looks like we're going to have small interest rate hikes unless we, acknowledge the reality of, I think, pretty strong inflation that's occurring and get in and start advancing beyond that. I think rising interest rates are the largest risk to home prices and property values that are out there, dwarfing anything on the supply or demand front that I can see.
I was talking to a good friend of mine, Daniel Arias, early this morning. He's out of Finance of America, and we were just talking about like what happens when rates go up. And first, the most obvious is refis go down. Most of us have taken advantage of the low interest rates, so that significantly reduces volume for conventional lenders. But what he reminded me of, and he was really spot on, is lenders are amazingly resilient at answering the bell when volume drops. And so what happens is you see a suite of new mortgage products that will start hitting the marketplace. The longer term IOs, the qualifying at your start rates, the graduated payment mortgage. What the lending industry does, that's from Wall Street to Main Street, is they figure out a way to get Ed and Bob and Chris and Mike and Lori and Jan and Jill to start borrowing money again. And so they will create products that will create interest in all of us to take a look to the left and consider borrowing. This is not all about the 30-year fix, though it's what we all talk about. It's really not what drives the market. And so I think what you'll all see is I'm in alignment with Scott. I think it'll probably be a little bit more radical than not this year. We'll talk at the end of the year and see how wrong I was again, but I think it'll be a little bit more radical. I think there'll be new products. I think we'll all be okay, but I don't think that's going to have any impact on at least my bullish perspective of the real estate market. Scott, do you have an opinion about interest rates and the impact of positive or negative appreciation in real estate?
Yeah, again, I honestly would defer to your opinion on what the interest rates what's gonna happen to interest rates over there, because again, I think you're just going to be more of an expert than me on the movements of those. Prior to hearing your discussion, I came in again to the call thinking we'll see probably a 25 basis point, ish, maybe a little bit more increase next year, something mild that probably won't have a large impact on the real estate market next year relative to the supply and demand factors. When you think about the supply and demand factors, we're just 4 to 5 million homes short on the supply side, and I don't see what is going to cause that to kind of come into play that much over the next year. It seems like raw material costs are high, labor costs are high. It's tough to get permits. There's no land in one part of the country. There's no water in the other half of the country to do that. So I just think there's a lot of constraints on adding a lot of housing inventory and supply to the market. And on the demand side, you see, I think, continued steady growth. You have rapidly rising wages in a lot of parts of the country with this. So I think those factors are probably, and then inflation and the CPI is looming on the horizon. So if I were to guess for next year, I think that real estate prices will rise in line with the CPI or a little bit advanced of that as the kind of more scarce asset than a lot of the other items a lot of other goods and services that Americans purchase. So, I would have kind of pegged it in that maybe if the CPI is at 6.5%, 6.7% last month, and you expect that to maintain through next year, that points to maybe like 7 to 10% appreciation. What I think will be interesting is because if interest rates do rise, and your prediction holds true, which I think again is a very sensible one for that, then what I'm interested in seeing is if in the last couple of years it's been very hard for investors to find cash flow on long-term rentals, and you wonder if rents actually grow faster than prices in a lot of the real estate market if the dynamics that we just discussed are true, and you wonder if subtly it actually becomes easier to find cash flow in the real estate market sometime next year entering 2023 than it may be for many investors today. So that's kind of an interesting maybe maybe a little twist on what may happen in the real estate market coming up next year. And what I believe is there's no one can truly predict all of these things, but what I believe is a reasonable possibility coming into the end of next year.
Yeah, I think we're in alignment. The CPI number, if any of you on this call hadn't been following, was the highest number in 39 years, so almost 4 decades. So I don't think there's any question about that. And the supply chains and the contractors and all of that stuff adds to the potential challenge of keeping up with the demand. I quoted something from you. I want to make sure I didn't misquote, Scott, when you were in transition to the phone. Did you tell me the other day that you thought we were 9 to 10 years of building behind to meet current shortage levels? Was that what you told it? 9 to 10 years?
Yeah. So I'm stealing that quote or that estimate from our head of data and analytics, Dave Meyer, who I think did a great video kind of outlining this and why he thinks that's the case. But yeah, his prediction is that we're 8 to 10 years away from fully bringing back supply to meet the estimated shortfall of 4 to 5 million homes. Yeah.
So like, if all of you take note, housing has changed. So we're just talking about your own housing. Housing has changed because you could work out of your home, some educate their children out of their home. You could take care of your parents out of your home. So people are buckling down, expanding, building out, adding ADUs. So home sweet home has changed. One, interest rates, even though Scott and I say they're going up and others say they're going up, even if they go up, they're still historically low interest rates. So your buying power is going to be unbelievable. The products that are going to come out, interest only, graduated payment mortgage, qualifying at your start rates, that's going to be better for all of us. You have a 5 million home shortage. You have rental opportunities. I don't want to ring the bell too much, but it just seems like in all the years I've been in real estate, the stars have never aligned to be an investor. You could reside, you can rent, you can play the short-term rental game. One of the things, Scott, you mentioned, and I don't know if it was in a book or a podcast, about getting into the game. Could you talk a little bit about that for anybody on the call right now that doesn't have real estate? And I think you were talking more like your 3-4 unit occupy one. Could you talk about that for a bit?
Yeah. So when I got started in real estate investing, it was 2014. I started my career in 2013 and wanted to not pay rent and live for free. So what I did is I saved up. I was making $48,000 a year as a financial analyst, and I saved up about $20,000 of that by living very frugally, working, moonlighting and driving Uber and making some odd jobs on the side, and year-end bonus, making a couple of investment things like our employee stock purchase plan and maximizing the value of that. And I was able to save up 20 grand and buy a duplex. So that was a $240,000 duplex. And I put down 12% with an FHA 5% down loan. I think actually a 3.5 or 5% down conventional loan would have been a better option looking back. But I wasn't as sophisticated in my knowledge of those products at the time. And I rented out the other half for $1,150, and then a roommate in my half. Each side was a 2-bed, 1-bath, two-bed, 1-bath units. One side rented for $1,150, $1,100 plus $50 for their 2 cats, and then my roommate paid me $550. So that's $1,700 in rent. My mortgage was $1,550, including PMI on that, and that allowed me to kind of live for free. And I think that's what's great about real estate investing for a lot of folks, is that is a reasonably accessible way to get into it. Yes, I'm levered at 95 to 5, 5% equity, but my estimation was, hey, if I'm on the side of the renter, I know that in over 10 years, the rent is going to increase. And I know that I've got at least a chance of appreciation, loan amortization, and being on the receiving end of those rent increases over time. And so I think that type of purchase, what we call a house hack, is a really attractive way for new people to get started in the real estate investing world. And a secondary benefit that I did not perceive of at the time, but kind of realized maybe a few years down the road, is that because I'm really a landlord, I'm collecting rent, and half of it is not my primary residence. With that, I can declare that income on my tax return, and then you guys, a mortgage lender, can come in and help me, you say, yes, that absolutely qualifies as income. Not only will we use that rental income to help supplement your wage income to qualify for the next loan, but if you buy a vacant property or an occupied property next, then 75% of that long-term rental income can also help you qualify. So it's an enormous boost over, say, a homeowner that purchased that. If I purchased that same property as a first-time home buyer without any rental income with that, it would have set me back years because I wouldn't have had history on my tax return of that income to help me qualify for the next loan. And I wouldn't have been able to use potential rent from the next property to help me qualify. So I think it was a massive boost in helping me get started in my real estate investor journey. And I think it would have been very difficult if I'd gone a different route.
Yeah. And look, that's probably going to be difficult for anyone on this call to do in most parts of California, but the other states we were talking about, the 12K down, lever, cash flow free, appreciation in real estate, tax benefits associated with owning it. I mean, there's just an unlimited number of reasons why that math worked. Living rent free alone was a good play on your part, Scott. All the other things that you hadn't thought about ended up making it a home run. I want to be mindful of our time, Gina. I know we have a number of questions, and maybe we could take the last 10 minutes and do a Q&A, Scott and I, with the team. Are you still with us? Or do you have snow in your area too?
I'm still here.
Great.
Yeah, we have plenty of questions. If you want to dive into those, let's do it.
Let's do it.
Okay. So the market is obviously very competitive right now. And this is for both of you, whoever wants to take this, but what is the best way of knowing when there is actually a good deal?
Scott, you want to start?
Yeah, I'm happy to take this one. So yeah, I think this is like the most common question that I get with this. And here's a simple, process to arrive at that point. First, don't look at the active listings. Don't pull up Zillow. Don't look at the things that are currently for sale. Instead, look at what has sold in the last 90 or 180 days. So earlier this year, I was saying you have to look at what's happened in the last 90 days because the market's changing so fast. But I think at this point in the year, the market is changing less quickly, actually, and the last 90 to 180 days works. And boil that down. Let's get clear on your criteria. You want to, I don't know what your criteria will be for a good deal, but mine might look something like this. I'm looking for a duplex, triplex, or quadplex in Denver, Colorado. I like 1950s builds because that's what my other types of units are, and I'm used to dealing with the problems in those and know what to expect and how to manage them. I like 2-bed, 1-bath, or 3-bed, 2-bath units because I think they're easier to rent in most periods of time. I command more rent than other types of units, and I'm very comfortable with those. I like a yard because pets, places that allow that attract pet owners give me a higher caliber of tenant occupant. And I like certain things with square footage, parking, those types of things. If you can get to a reasonably articulate understanding of what you want, that's a great starting point. And then from there, I can look at the market and say, okay, from that list, what has actually sold in the last 90, 180 days? And I can whittle that down and say, I like this neighborhood better than that one. I like this edge of that neighborhood better than that edge of this neighborhood for these reasons with the city plan or because appreciation prospects. I'm willing to take less cash flow and more appreciation potential over there than I am over there for these reasons. If you can get clear on those types of things and narrow your list down so you say maybe 10 properties have sold in the last 180 days or 5 properties that have sold in the last 90 days, that you say, yes, I would have bought those properties if they were offered to me today. That defines good in the context of your market and what you're looking for. And from there, great, a property of that type, if 5 have sold in the last 90 days or 10 in the last 180 days, a property of that type sells once every 18 days on average. I'm not living in fantasy land looking for that one property that has sold in the last year that was the home run. I'm living in a reality where I have a chance at making an offer on that type of property every 2.5 weeks. And now I set myself up to go fishing rather than, aggressively chasing any one of these random deals. And I say, okay, a property that meets my criteria just hit the market. I may not be leaving work immediately at that moment, but I'm canceling my evening plans and going to look at that. And I'm going to make an attractive offer that evening. And if I do that 2, 3, 4 times, I'm likely to get that deal in the next 90 days.
Yeah, the thing I would add to that, that's excellent, Scott. The thing I would add to that is make sure that if you're a serious buyer, whether it's for your residence or an investment, that you're credit qualified. Get with whoever that lender is that you use. Make sure you understand your credit report. There's always something on it that you didn't expect that you're going to have to deal with. Make sure that you have your down payment situated and clearly outlined, whatever your income levels are, understanding your debt ratios, and bring a credit qualified package to the table. Not a pre-qualified letter, but a pre-approved letter, because it'll act closer to cash than the alternative. Or if you happen to have a lot of cash, cash will elevate that opportunity to get your deal considered. And then you could do a delayed purchase where you get like 75 or 80% of your cash back after you close. So both great suggestions. But I like the idea, Scott, of really understanding your area. And listen, realtors out there, if there's any realtors on the call, they would verify this. Get with the pros in the area and tell them what you're looking for, and they'll drip you every single morning of like-minded properties. So for the short-term rentals, I got stuff dripping to me in La Quinta and Scottsdale and Nashville, where every morning I wake up, I know exactly what's going on the market with the local pros, either off listings or MLS stuff. And, it keeps me, even if I'm not ready to pull the trigger right now, it keeps me ready and connected to what's going on in the marketplace. Good question, whoever that was. What else you got, Gina?
Okay, so this question is from Greg. This is for Scott. What is your thought philosophy on those who say to own a few properties free and clear, or to use the equity in the properties to maximize the number of properties held under management?
We get this debate all the time. And I don't think there's a right answer. I think it's just your preference. Do you sleep better at night with a handful of paid off properties and knowing that you live within your means and you can kind of coast on that forever? Or do you want to mathematically maximize your wealth creation? You're likely over a period of time, if long-term average inflation rates are 3%, 3.5% or so in the Case-Shiller index for existing property sales, resales. So you're going to get a better return over time if you own leveraged real estate than if you own unleveraged real estate. However, you're going to probably have a few moments throughout the decades where things get a little shaky with market downturns and those types of things. Personally, I use leverage and keep my portfolio levered because I believe in those long-term mathematical principles. And I'm still in, accumulation mode and building my portfolio. With that, I earn money from my job, and I capitalize other parts of my asset class conservatively and consistently. But if I were ever to really kind of reset my portfolio and wind down, there's something attractive about having a handful of paid off properties and no worries, even though that you're going to get a lower long-term average return with the paid off property. So again, a big debate in the community with no right answer. That comes down to personal preference and what your life goals are.
Yeah, and just so everyone's clear on leverage, I'm sure you all are, but if you bought a home for $100,000 cash and it appreciated 10% and it was worth 110, he's made 10% on his money. He bought the same $100,000 home for 20,000 down and it increased 10%. He's made 50% return on his money. So that's the whole ROI analysis. What I think I would add to that is it also depends on what stage you are in your life. Early out the gate, I thought Scott was 100% correct. He levered to the hilt. He put 12K down. He got in. He was focused on rent free, and I think that was great. And he didn't tell the whole story, but he probably made a bunch of money on that and flipped that into the next deal, or he owns it with little debt on it at this stage. The point is, like for me at my stage, and I've been a real estate investor for 3 decades. I don't go into transactions highly levered. I go into transactions where I have a ripcord plan that if everything Scott and I said was wrong and the market tanked, I'm going to be okay with that piece of real estate. That isn't because I'm smarter than the average bear or I have more money than the average bear. That's just through time. As you get older, your mistake level, the gauge of error you have shrinks, and you just can't risk it all on a thought, idea, or a podcast at at that stage of the game, right? The first third of our life, we learn. The second third of our life, we earn. And then, the third third of our life, hopefully we're giving back some, which is, the fun part. But I just think the risk level changes as you progress through time. Good question, whoever asked that.
Third part of your life, you're not digitally native in that third part of life, but you're absolutely perfect on that with my property, right? So I bought that duplex. It appreciated dramatically over the next couple of years, and then I cash out, refinance to purchase more. So I still own that property. I improved my returns by re-upping my leverage position and buying more real estate with that. And then, all of this real estate investing, I think, underlying it comes with this very strong and I think conservative financial position with this. I think many real estate investors will tell you that they have a lot more cash on hand across their position. Maybe they have cash reserves for each property. Maybe they have one lump one for their business or one giant lump one for their personal and business, but there's probably a much more conservative allocation of cash or other types of currency that folks hold to offset that risk. And that absolutely does factor into your overall return on your entire portfolio or net worth with that. But I think that's investing from a position of financial strength is imperative. All your great returns with leverage go to zero if you go bankrupt. And that would be quite embarrassing for someone who's written a book called Set for Life as well.
It is interesting. The financial crisis, if you ever, we could do 2 hours on that, but the financial crisis happened because loans were being done to people that weren't qualified and the leverage was at 95 to 100. So they were doing 100% second homes to $1 million with a 580 FICO score on bank statements only. So when you think about that, when they don't have skin in the game, everyone just pulled the ripcord and let those properties go. And we had just a plethora of real estate that was over encumbered and took over 10 years to funnel through. Where we are right now, we have the lowest LTVs, we have the greatest FICO scores, we have lessons learned from the last financial crisis, and guys like Scott writing books that we could all learn from some of those mistakes and opportunities. And I just think that the overall real estate community is better equipped today for any sort of those things. But there is a clear differentiation when I talk to a young 20-something-year-old getting into real estate or a 55 and older that's been in it in terms of leverage. And I think all of them can be right. What else you got, Gina?
Okay. First, shout out to Mark Davis, who is a new broker with Civic. He shot in a question. We're not going to have time to get to that one. We have one right in front of him that I'm going to go to. But for the last question, this is for Scott. With the current real estate environment and investors having to pay minimum list price or above list price, how is this impacting your investing philosophy with the BRRRR method? And similar inquiry in regards to the supply chain.
Yeah, great. So first off, when we talk about the BRRRR method, that's buy, rehab, rent, refinance, repeat. It's an advanced and very aggressive investing approach if applied to the maximum with that. I personally don't BRRRR. It's not my core philosophy or strategy. And that's one of the things I think that's great about BiggerPockets is there's hundreds of different ways to invest. You have people making money in condos in San Francisco and in all cash rentals in Milwaukee with this and everything in between with that. So the BRRRR strategy is popular on BiggerPockets, but not one that we necessarily promote more than anything else. It just happens to be one that is very popular. And so that's one of our best-selling books and most popular podcast episodes. It can seem that way because it gets hyped up and shared with the community, but it's not something that we actually emphasize any more or less than the other strategy. It is a very powerful strategy and very effective with that. My personal strategy is not the BRRRR method. I simply buy a property every year and a half, and I have for the last 7 years pretty consistently, and buy a little bit bigger of an asset each time as my financial position sustains it. So my plan is pretty boring. Over 8 years, I've accumulated 7 years, I've accumulated 4 properties. I'll probably buy another one in spring, summer of next year, and continue to put down my 20-25%. I'll either use that for my existing portfolio or bring additional cash to the table, keep my portfolio leveraged at that kind of like 30% equity, 70% debt level, keep a large cash reserve, invest a lot in stocks outside of that, and just kind of pile up the assets one by one over the course of the next 15, 20 years. So my strategy has not been changed at all based on the market conditions that have been going on with it. What impacts my strategy a little bit more is my personal life. Like when I became CEO of BiggerPockets, I actually didn't invest for 2 years because I was so focused on building the business and didn't feel like I wanted to have a distraction there. And I've resumed that investing outside of the real estate business in the last year as I got more comfortable in the role.
We could answer that other question. I know if someone needs to peel off, we still have an awful lot of people on. Why don't you ask Mark's question?
Yeah, absolutely. So Mark is a new broker with Civic, and this is for you, Bill. He wants to know if you just have any suggestions on how to best market to both seasoned investors and newer investors, and wondering if investors are more or less bullish on real estate going into 2022.
Well, I think most of the investors I've talked to are very bullish, and really kind of part and parcel to your earlier question about, what do I do about paying top dollar for these listings at list price or 103% of list price. If you learned anything in the in our industry insights today, you learn that we believe, the people that have been in the business a long time believe, real estate's going up. So if you're going to overpay lists by 1 or 2%, but you're hearing appreciation numbers from 8 to 12 or higher, along with the tax benefits and some of the cash flow discussions we've had, I think that whole argument of overanalysis creates paralysis is real. And taking that step and getting in the game, I do think is important. And I think the timing today couldn't be better. We do about 35 to 50 conferences nationwide a year. And there's a whole slew of investors that go through those conferences, whether that be ABS, IMN, Apple, who else? Help me on that, Gina. You look at those conferences, tons of them. So, we spend a few $100,000 a year on them. And really our account executives go there to connect with investors. So I think getting where the investor flow is probably your best way to market them. Also aligning yourself with good real estate agents and finance guys, both on the conventional and BPL space, is good as well.
And local RIA networking groups has been a really successful avenue.
Scott, do you have any ideas on that?
I think that's a great response. And I just also encourage you to understand the investor, right? This is not somebody who's going to buy that property next month because their lease is expiring. This is somebody who's going to be a little bit more patient, probably will buy in 2 to 6 months, a deal or several deals that make sense. And then I think that there's some coaching around and understanding what type of income can help them qualify, making sure that understanding that, I talk to a ton of investors that are amazed by the fact that their financing qualifications explode after house hacking for several years, like I indicated earlier. I recently, on my last property, was quite embarrassed because I had left all of my money in my LLC and could not use that as easily to purchase my next property. So coaching, us through those types of situations to make sure that those problems with closing are easily avoided with that. Because I had to scramble to collect cash from my stocks, for example, instead of the money that I had set aside in my LLC to close on that property, helping us kind of understand those nuances of our position, knowing what helps with qualification and what will be, a setback in the closing process, and kind of coaching us through that. I think that would be really powerful from an investor-friendly lender with that. And I also think one of the big ones is I actually don't know the answer to this. Maybe you do, Bill. How does short-term rental income factor into the financing equation? Do I need 2 years of history on that?
Yes.
I think that's going to be an exploding market for us over the next years, and understanding how that income helps me qualify either from a historical basis based on my historical income, or on a go-forward basis from buying a property with the intent to make it into a short-term rental.
Yeah, so I think conventional lending, so your Fannie, Freddie, Jenny lending, yes, they're going to want to see 2 years average. And then as you start getting into some of the non-QM and BPL, it'll really, there's entities that we rely on, House Canary or Air DNA, that actually can predict cash flows on that rental income, whether it's short-term or long-term, that helps credit qualify a borrower. It all goes back to something we said early on. Get your credit package, get credit qualified, whatever kind of lending you're using. Doesn't matter. If you're using private money, get credit qualified. If it's a non-QM space, get credit qualified. If it's conventional, there's more documentation, get credit qualified. And that just gives you the purchasing power, not only to know what you can do, but to actually do it when somebody says yes on an offer.
Yeah, I think that's what I should have done by my last one. So I didn't have that scramble at the end to, move a bunch of money through some weird channels to close.
All right. Well, it sounds like we have more questions than we have time for. Thanks to those of you who continue to stay on over time. This is such a good conversation, and I don't want it to come to an end, but we got to wrap it here. So I just want to say a huge thank you so much to you, Scott, as our special guest, Bill, for the incredible discussion. Folks, if you want to dive into real estate investing topics, BiggerPockets.com is an absolute ocean of information for you to swim in. The topics that Scott and Bill have touched on are tip of the iceberg for what you can find when you dive into BiggerPockets. So if you want to educate yourself more about real estate as an investor, like Scott mentioned, if you are a broker or a loan officer and you want to better understand the investor, join a forum. You can read articles. It's a wealth of information. So thank you all for attending today, and wish you all a great day.
Yeah, Scott, thank you very much. You were great, and we'll do this again soon. Happy holidays to everybody.
Yeah, thank you so much, Bill, Gina, and everyone for having me on. And again, I apologize about the power going out here. That robbed us of about 10, 15 minutes of discussion. So I apologize, and thank you again for having me on.
I apologize for being 54 and not knowing how to use my mic. See y'all.
Thanks, everybody.
Yeah.
Cheers.
Thanks, everyone. Bye-bye.